I would like to start by thanking you so much for organizing this platform where we actually had wonderful sharing of knowledge and insights. I am very, very impressed by the previous speakers, and I can tell you that I've learned a lot from what our previous speakers have actually presented to us this evening. So I would like to make my contribution as well to this platform. My contribution will be about wealth planning, commonly known as financial planning, if you may call it. Some people call it financial planning, but I call it wealth planning. So this topic is not new to anybody. I think that most of us actually are aware of it already. And I believe that what I'm going to be speaking about today, it's not going to be unique to most of the people. But I believe that there's certain things that we tend to take for granted. And that's why I'd like to speak about this topic today, just to enlighten or just to highlight or stress the importance of wealth planning for all of us. So wealth planning is basically about a process of helping us achieving our goals. I do believe that most of us have got goals in life. We've got certain things that we want to achieve, but I also know that many of us do not actually have any goals at all. But that's why you actually need professional people like myself and others to actually help you in this journey of financial planning, which is a process, it's a continuous process. It's not something that comes and goes. It's actually something that takes place most of our lifetime until we die. And you may ask yourself, why financial planning? Financial planning have got components or main things that we look at actually in life. And we look at these things because of the challenges, because of the problems that we face in life every day. So the first component I would like to speak about is risk management. Risk management is basically mitigating what can happen tomorrow or next year or the other year. And why do we have to worry? Why do we have to actually manage this risk? It's because in life we've got problems. Everybody has got problems. We've got a problem of dying too soon. We've got a problem of becoming disabled. We've got a problem of becoming diagnosed of a critical illness at a time when you don't really expect it. But if you've planned for it, then it wouldn't be so much of a hassle. Well, somebody can ask, why actually do I have to plan for these things? Like death. When death happens or when death is to happen, we need to make sure, most importantly, about three things that we all know. We have to take care of our dependents. I believe that, especially in the African community, as women, we have financial dependence. We have the dependence burden in the African society. We have people that we're looking after in our working lives. So we don't want those people to suffer should something happen to us if we die too soon, if they're not able. Most of the people will say my family, of course, my immediate family. I would want to protect my husband. I'd like to protect my children that are still minor, going to school, having certain needs. Because that's one of the reasons why we actually want to mitigate this risk. The other one could be liabilities. Who doesn't have liabilities? If you don't have liabilities, then you are so lucky. But most of us go into liabilities, especially for bigger assets like your home. We take a bond to secure a home for our family. And we obviously pay a lot of money over the years towards this asset. And we don't want our family to lose it because we just died. We want to protect it for them. So we want to make sure that we don't burden our families with the liabilities, long-term liabilities like the bond, credit cards, short-term liabilities as long as long-term loans and so forth. If you know the process that takes place in administering your estate after you've died, the executor has actually got to account for each and every liability that you have. And it must be paid before everything goes to your beneficiaries, to your nominated beneficiaries. So we want to make sure that all liabilities will be paid so that our family, our beneficiaries, our dependents will inherit free of debt. And another thing, obviously, we want to make sure that the liabilities of the estate when we die are also paid. Because you know what, we also pay debt when we die. There's estate duty to be paid. By the way, you also pay income tax when you die. You pay a CGT, all things like that. So all that is liability to the estate. Now, if you don't plan for it, you're going to actually put your family at a stake because they'll have to provide money before they can actually inherit anything. So because of that, you can find that the things that you intended your family to get, like a house, will not be there because the executor has got to sell it to realize the funds to pay off liabilities. So that's why we have to worry about risk management, death in particular. Now, besides protecting our dependents, making sure that liabilities will be paid, and also estate liability will be paid, we also need, there's also a problem of becoming disabled, being denied of your capability to make money. You can only make money if you are able, if you are physically able, mentally able. But something can happen that can actually take out all that ability, which is disability. It could be mental illness. It could be due to an accident. It could be due to an illness that you become paralyzed, that you cannot actually continue earning money. So that also needs to be protected. You need to think twice. If you're a family person, you have dependents. If you become disabled today, what happens to those people? Who is gonna take care of them? What happens to you? You've got a bond, you've got a car, you've got all these things, children's education. What is going to happen to all that should you become permanently unable to continue making money? So that's why we need to plan for it. It's very, very important. And another thing that people actually tend to ignore, or they take it not seriously, is critical illness. Our previous speakers have talked about mental illness, things like disorders that can actually make you incapable of even continuing to do anything, like depression, bipolar depression. You could be medically bothered because of that. So should you become diagnosed of a critical illness, do you have enough money to take care of the associated concerns or problems or costs that come along with that kind of illness? This could be like topping up your expenses that are not met from your medical aid scheme. This could actually also be like things adjusting yourself, taking on a caregiver at home to look after you because you're unable to do anything and your family is not there. They've got to go and work. They're not at home to take care of you. So all those are expenses that need money. So that's why we actually need to plan towards that. So the other component of financial planning that I need to actually talk about is retirement planning. This is actually something that is highly neglected, especially among us Black people, you know. And women, we tend to think that our husbands will actually provide for anything. Tomorrow is not promised to anybody. Your husband may not be here. Your husband also needs to do planning. If he didn't do planning, then he would die with leaving you with nothing and you don't have money for retirement. So retirement is basically putting in place things that can help you achieve or arrive at the goal or the desired income that you need at retirement, the income that you need at retirement. This could be money. You have to sit down and actually do a calculation with the help of a professional like myself. What are actually the best needs in a retirement? What is the expected expense in retirement? medical aid, rates and taxes. Where are you retiring? Are you going for holidays? All those kind of things. So that will amount to your desired income. And then you will start laying strategies on how to achieve that income, okay? And also that could be through, most of the people will say, I have a pension fund at work. I don't actually need to invest to save more towards my retirement. But this is actually a problem, a very, very big problem among society today, because people tend to think that pension funds at work are going to be enough. They will never be enough. From my calculations as a professional in this field, I can tell you that probably 99% of the people are not okay, will not retire financially independent because they have relied on pension funds. It's not enough to provide you the income that you want. And the bad thing is that as we move jobs and we move from company to company, people tend to cash in those benefits and spend that money on other unnecessary things, thinking that they will catch up, they will accumulate more, which is actually not possible. You know, you've got to plan from day one. You start working, you've got to start actually putting up a retirement plan if you want to achieve it, because it becomes actually very difficult for you to achieve this plan as time goes on. Like if you come to me, you're already 40, 45, you've not saved anything, I'll probably tell you to save almost 100% of your income right now towards your retirement. So it's something very, very important. And we all know that when you save money, besides the pension fund, when you save money into a retirement annuity, which will be now your personal savings towards your retirement, the government actually incentivizes you for doing that, because they want us, they incentivize us, saving towards our retirement by allowing us to deduct all those contributions from our taxable income every year. So at this point in time, you can actually you can actually deduct up to 27.5% of your taxable income if you contribute it into a retirement fund of any nature, be it a pension or a retirement annuity. So your aim actually should be to actually take advantage of that. We all want to save a penny. We know that most of our income are taken by taxes, almost 40, 45 or 41% is taken by, the government. So the only way you can actually get that money back or claim or save that money is through a retirement, a contribution to a retirement annuity, because all the contributions up to 27.5% are tax deductible. So it is actually very beneficial. First, you'll be actually saving more towards your retirement to achieve your desired income. And again, you're benefiting. It can actually give you a refund from SARS at the end of the financial year if you do that. And you can deal with that money the way you want to. It is also the only money that is actually protected from your creditors. If you become insolvent and they sell all your assets, this is the only asset that will not be attached by your creditors should you become insolvent. Of course, we don't wish for that, but if it happens like that, it is a nice way of actually hiding your wealth, And again, the investment, retirement is an investment. Retirement annuity is an investment. You're investing money for your retirement. And the good thing is that you are not going to pay any tax on that money that you put into a retirement annuity. You know that normal investments, of course, you pay all kinds of taxes, interest, income, you pay tax. You pay tax on capital gains. You pay tax on capital growth, on shares. You're going to pay tax on all the normal investments. But on a retirement annuity, the return that you get on that investment is actually tax-free. So that is a very, very nice tool for us to use when we're doing our planning to reach our goals. All right, so the third component of financial planning or wealth planning that I need to talk about is basically investment management. Investment management is basically putting strategies or vehicles depending on your objective, we do have various objectives when it comes to investment. You could be actually wanting just to save for a holiday at the end of the year. You could want to save to deposit on a home after 3 years or 5 years or a certain period of time. You could maybe want to buy a TV, a nice TV for yourself after 3 years. It all depends on the objective that you have. So based on your objective, then we will actually help you to align those goals or objectives to the best solution, in terms of asset classes, in terms of what kind of investment product to choose and to invest in. So in order for you to actually arrive at those objectives. Other than that, it could actually very much be aligned to your retirement goals as well. Because besides putting money in a retirement annuity, especially if you have maximized the 27.5%, which is the maximum contribution you can get, you can actually diverge those contributions to other vehicles like unit trust or share portfolios or offshore investments as such. And that will all be directed towards achieving your retirement goal or probably your future goals as well. Okay, so that's your investment management. Now, the other one is tax planning. Nobody wants to pay tax, as I have said previously. Nobody wants to pay a penny to SARS. So we want to minimize our tax as much as possible. So in financial planning, we do actually help you to minimize tax on various investments, obviously on the various vehicles that you can choose to arrive at your goals as set by yourself and myself as a financial planner. So one of them could be looking at actually what are the tax efficient investments, obviously based on your tax bracket as well. Some of the investments are tax-free, they're not really tax-free, but they reduce your tax. They help you to save on tax, like the so-called endowments, because endowments are taxed at a tax rate, a company rate of 30%. So if you are in a bracket of 41, 45%, it makes a lot of sense for you to choose endowment so that you can minimize the tax. Retirement, I've talked about it already. Investing in a retirement annuity saves you a lot of tax. And also we've got now the new tax allowance that the government gives us, which is 36,000 that you can invest every year without having to pay any tax. So that's actually a very good thing. If you are a person that is starting to put money away for your long-term goals, it is actually a very nice allowance to use, because it means that all the returns that you're going to get on that investment will never be taxable. Even if it grows to 2 million, 1 billion, you'll never have to pay tax on that money. But the lifetime contribution lump sum is actually 500,000 at this point in time. That is due to change as time goes on, we believe. And also that limit of 36,000 can change anytime, any year. The government can decide to increase that. It started at 30, went as 33, and then it is at 36 now that you can invest. So every parent can actually take advantage of that. You can also open the tax-free investments for your children to take advantage of that. Okay. And then estate planning. Estate planning, now you've done all these things, you've worked so hard in your lifetime, you've built all these assets, you've bought an estate, all these nice assets during the lifetime and, for your own enjoyment and your family. But now it's time to pack and go. How are these going to devolve? You should be concerned who is going to take over these assets. And in an African setting, how things are, if you don't leave a will, a will document, or what we call a last testament, if you don't leave that document, it's chaos for your family. And actually that can be very, very, very disadvantageous to your family, to your children. The children can drop out of school because the family members actually took over everything, took control over everything and all the monies. And you know what money does to people. They will not remember your family. So it's very important to actually make this last planning and say, okay, I've done all this, but I want these people to inherit. I want to make sure that when I die, these people will actually inherit these assets. Okay, so then you actually round up that in a will document. Everybody must have a will. Everyone must have a will. If you don't have a will now, it's high time you go and do it. Don't wait for your husband. African women, we put everything, we think our brains are actually in our husbands. That must change, as the previous speaker talked about. We must change that mindset. Go and do a will. If you're married, do a will with your husband, especially if you're married in a community of property. It makes a lot of sense for you to go and do a will with your spouse. It makes a lot of sense because, I mean, you don't have to hide anything from each other. By virtue of your marriage, 50% belongs to the other anyway. So it's always good to actually do a will with your spouse to reach an agreement on how that 50% is going to devolve. So a will is very, very important, and also not only actually distributing assets to your beneficiaries, but also it's very, very important to make sure that all the liability in the estate is paid off, is planned for. There will be money to pay estate duty if there is. And I mean, people like myself, we can help you minimize that estate duty as much as possible. Things like setting up trusts, if that is actually cost effective. Things like taking out life insurance to pay into the estate and so forth. So we can actually always help you to plan properly for your estate. And obviously, having said all that, very important to note, you cannot do all those things that I've mentioned without proper financial management. Okay, financial management is to do how you manage your finances, your cash flow, your debt management, your budget. So it all starts with actually having a budget. Everybody must have a budget. Every family must have a budget. You cannot spend anyhow. You have to account for every penny that you have. You know, it's a roadmap. It's a roadmap. It's like going somewhere you don't know, but you don't have a GPS. You know, you're going to go everywhere and spend a lot of time wasting a lot of resources. So if you don't have a budget, it means that you are spending anyhow, because money is in the account. I can afford a Gucci bag of 5,000. I can pay it right, you know, because you don't have a plan. You know, you are just going anyhow. So a budget is a roadmap. It's very, very important for you guys to draw up a budget on your desktops. And this will guide you on how to account for your finances. You put the income, you list all the best expenses, not anything like, you know, luxuries or whatever the case may be. Of course, you can actually input in money for your entertainment and all that kind of thing. But a budget is actually meant to direct you on how to spend your money wisely. Okay, you spend your money wisely because it will tell you how much disposable, how much money am I remaining to spend, so you don't end up in the shop buying a perfume of 5,000 because the money is there. It will tell you that you only have 200 Rand to spend, or 2,000 to spend, or 20,000 to spend, depending on your income. So then you don't go overboard. You'll be conscious. And as time goes on, you get used to that. It gets into your brain. And okay, say, okay, this is the only money I have at the end of the month, so I can't indulge. I can't indulge in certain things. So a budget is actually a very, very important aspect of financial management, and that's how it starts. Now, having you realize that you have disposable income, that's how you actually draw up your goals. I want to achieve this, and then we can go into the action plan under risk management. How much life cover do you need to take out? How much retirement actually savings do you need to make now? How much investment you need to make for the future needs, for the education of the kids? and for your own personal goals, like, you know, the holidays and buying assets like that. Okay. And then obviously, another part of financial management is an emergency fund. And I think most of you have heard your bank has telling you to open an emergency fund. Okay. If they've not told you about that, they have actually not done you any good at all. You can actually sack that banker. So why do you need an emergency fund? Emergency fund means that that's the money that you can actually draw out quickly, immediately when you have an emergency. An emergency, you need money now. So if you don't have an emergency fund, guess what you're gonna do? You're gonna call the bank and say, I need an overdraft. I need to increase my credit card, blah, blah, blah. All that is bad financial management. You're going into debt, you're killing yourself. You know, your future plans, you're killing them because you'll not be able to save when you have too much debt. You know that. And I think, you know, I'm talking to you guys. Some of you have gone through that and you've overcome. Some of you right now are still in this kind of situation whereby you cannot actually make ends meet. You're earning so much money, but you don't know where that money is going. And you ask yourself, oh my God, why am I working? That's actually what leads to depression. Our sister talked about depression, anxiety, and all that. Sense of hopelessness. You wake up every day to go and work so hard. And at the end of the day, you have nothing because of poor financial management. So you need an emergency fund to draw from that in case of any emergency. And I can tell you why I'm saying that is because if you start these plans, the long-term plans, retirement, life cover, risk cover, and your long-term investment goals, and you've not set up an emergency fund, you're gonna always call the financial planner to say, please cancel my investment. I need money to repair a tire for my car. Can you imagine? That's actually very, very poor planning. So you need an emergency fund, and my recommendation will actually be like 2 to 3 months expenses saved up in a sort of a call account. It could be a money market call account, or it could be a money market account, whatever you want to actually use, which is actually giving you that the highest interest at this point in time. But yeah, you must be able to access the money immediately, immediately without even calling your banker. You should be able to access that money immediately. That's an emergency fund. Yeah, so basically that's it. I think that's it. So for you guys that will need assistance in any way, towards achieving, setting up goals for your life, if it's not too late, even if it's too late, we can always actually do something about it. Most important thing is to start somewhere, instead of not starting at all. So yeah, that's my my contribution, guys. And I think that you've derived value. And if you've got any questions, obviously, I'm happy to answer any question that you may have. If you want to contact me on a personal basis, the coordinators will have my contact numbers. You can contact me and I'll set up a meeting and draw up a financial plan for you guys. Thank you so much.